Hello and a very warm welcome to Moneycontrol. My name is Mugdha Kalra and today we are in conversation with Yogesh Singh, Head Investment Research and Retirement Advisory Department, Stockholding. Yogesh comes with global exposure of working with renowned organizations like Deloitte, Grant Thomson, Dun & Bradstreet, etc. and is here today to talk to us about floating rate saving bonds. Welcome, Yogesh.
Thank you so much, Ms. Mugdha, for having me over.
First question, what are floating rate saving bonds 2020?
So floating rate saving bonds 2020 are Government of India securities that are issued by the Reserve Bank of India. So by that very nature, they are carrying only sovereign risk. So they are very safe investments. And as the name suggests, floating rate, the interest that is payable to an investor is not fixed for the tenor of these bonds, which happens to be a 7-year maturity tenor. Rather, it is floating to a benchmark, namely the National Savings Certificates, that is the NSC, plus 35 basis points spread. So basically, whatever is the contemporary NSE rate, like today it is 7%, 35 basis points or 0.35% spread over that, which comes to 7.35%, determines the per annum interest or coupon that an investor will be entitled to on these floating rate bonds. So as I said, since the interest rate or coupon is floating, it is reset every 6 months on the 1st of January and on the 1st of July. So this year, a couple of days back on 1st of January, since the contemporary NSE rate was 7%, the floating rate saving bond was increased from erstwhile 7.15% to 7.35%, which will be the interest one would get for the period of 1 Jan to 30th June on 1st of July 2023.
What are the prerequisites to subscribe?
It's very simple. All resident Indians, whether in the individual capacity or under joint holding, or anyone or survivor basis, or if it's a Hindu undivided family, they are eligible to invest in these bonds. Unfortunately, NRIs or even PIOs are not eligible. And so these bonds, they have the facility for the investor nominating somebody as a nominee. And if somebody wants a minor to be investing in these bonds, then on behalf of the minor, the guardian parents, they too are eligible to open something known as a bond ledger account, which is nothing but an account that is opened in order to hold the issued securities by RBI in dematerialized form in these bond ledger accounts, which is kind of peculiar to the floating rate saving bonds. So these are the simple eligibility criteria.
From financial literacy point of view of the young, this is fantastic.
Not only from a financial literacy point of view, but as we will discuss in the course of this interaction, just as a standalone investment, even though technically it's not a fixed rate return scheme because it's floating rate, yet if it were to be benchmarked to fixed rate return schemes like bank FD, or a regular government security, say a 5-year government security today is giving a yield of 7.15%, these floating rate saving bonds are meritorious compared to these. So we'll talk about that.
So is there a minimum or a maximum amount or a limit for investing in these?
Very true. So there is a minimum investment of 1,000 rupees that has to be put into these bonds and multiples thereof. There's no maximum limit. And the bonds are issued at par value or face value. So, unlike, say, government security, which come with a fixed yield for their maturity, where the price at which I, as an investor, am able to buy is dependent on market interest rates for that particular security. In this case, that is floating rate saving bonds, the bonds are always issued on par value or face value.
All right, the next question that perhaps everybody asks is tax kitna dena hai? So how much tax does one have to?
And rightly so, because tax, particularly for higher tax bracket, tends to be a concern. So in this case, unfortunately, the income that one gets through coupon is added to the taxable income. And there is TDS also, which is applicable, I believe, at the rate of 5% plus your education and health cess is applicable. In case somebody is not paying tax, then they have to fill a particular form called Form B in order to submit proof that they are not paying any taxes. So in which case the TDS won't be deducted and,
All right. What is the tenure of the bonds?
So I shared this, Mugdha. The tenor is fixed at 7 years, but the rate is floating in the sense that it is benchmarked to the National Savings Certificate plus 35 basis points, which is reset twice in a year on 1st of Jan and 1st of July.
Okay. I want to come back to the point you made again on are they transferable, and also about the nomination facility so that we can have more clarity on that.
So unfortunately, the bonds are not transferable, nor are they traded. Unlike, say, regular government securities, which also are issued by RBI on behalf of government, as are the floating rate saving bond. So the floating rate saving bonds are not transferable, nor are they tradable. So in that sense, it scores poorly on the liquidity front, because basically it translates into the investor having to hold it for the fixed 7-year maturity. Nonetheless, there is some buffer that is provided to senior citizens who are above the age of 60, wherein their holding period has been reduced. So if somebody is in the age bracket of 60 to 70, they need to hold it for a period of 6 years. If it is in the age bracket of 70 to 80, that holding period comes down to 5 years, and above 80, it becomes 4 years. But keep in mind that if someone were to exercise this prior to 7-year maturity exit, and that someone would have to be a senior citizen, there will be a penalty of 50% of the interest that is due and payable to them for the last 6 months of their holding period.
All right. Okay. Thanks for adding the last 6 month bit.
I know, otherwise it could have been a shocker.
Exactly. How much interest will the floating rate saving bonds bear, and when are the interest payable?
Yeah, so I shared this, as the name suggests, these are floating rate saving bonds. They are referenced to a benchmark, namely the National Savings Certificate rate. And over the National Savings Certificate rate, at the 2 times in a year when these floating rate saving bonds interest rate gets reset, so at those 2 points in time, 1st of Jan and 1st of July, whatever is the prevalent NSC rate, over and above that, 0.35% is added to determine what these floating rate saving bonds are going to pay to an investor. Please keep in mind, it is interesting fact that the National Savings Certificate in turn is benchmarked to the 5-year government of security yield plus 25 basis points. So in effect, approximately one can say that the interest that these floating rate saving bonds 2020 taxable are fetching an investor is the 5-year GSEC yield plus 60 basis points or 0.6%, which actually is pretty attractive. Because if in today's date you were to look at, say, the 5-year GSEC yield, it would be around 7.15%. And the 7-year GSEC yield, I'm talking about a 7-year GSEC yield in order to compare apple to apple with the 7-year tenor of the floating rate saving bond. So the 7-year GSEC yield, which will give you a fixed yield for maturity, may be around 7.2%. However, this is giving, the floating rate saving bonds is giving 7.35%. So there's a spread.
Can we have more clarity on the nomination facility?
So these bonds, just like pretty much other investments in which are eligible for investors to park their money in, they provide the facility to name a nominee in case something were to happen to the primary account holder. So yeah, one can name a nominee or multiple nominees. In case there are multiple nominees, of course, they have to specify the share that they would be entitled to. So yes, the nomination facility is available.
And what are the several advantages of investing in?
So that's a very interesting question, Ms. Mugdha. There are several advantages because one, since the interest rate is pegged or referenced to the NSE rate plus 35 basis point, it kind of takes away the guessing work on an investor's part of what the interest rate cycle is going to be over a 7-year period. So let me give you an example. Typically a lay investor probably would not have the foresight that if I'm investing money today in a 7-year maturity investment, and which is a interest rate fetching investment, as to how the interest rate cycle is going to move over the next 7 years. Typically, they don't have the foresight. So if supposing they were to, as a hypothetical example, decide to put their money in a 7-year maturity bank fixed deposit, which say in today's date is fetching say 7 or say 7.1%. And if after them having put their money in the bank FD, 6 months or 8 months down the line, the interest rates were to go up to 8%, so they are bearing an opportunity cost. So that opportunity cost possibility is taken away in the case of floating rate bond, because since the rates are floating, even if interest rates were to go up subsequent to the investor having invested their money, so say 6 months or 1 year down the line, if the interest rates have gone up vis-a-vis the time when the investor had put their money, since at the interest reset date of 1 Jan and 1 July, there would be again a referencing to the prevalent NSE rate at that time, they would be able to fetch the benefit of the higher rates.
Got it.
So I'm sorry, there's just one empirical statistic I'll share with you. So if one were to consider the period of April 2016 to Jan 2023, so that's approximately 7 years, covers some 28 quarters, in which 14 quarters were there where interest rates were going up and 14 quarters they were coming down. So in a way, it's covering an interest rate cycle. So over this period, the floating rate saving bond has outperformed the average returns that one would have got from bank fixed deposit rates for more than 5-year maturity by around 1.3%. And both of them are taxable. So it's not as if anyone is giving any relative tax advantage. Likewise, even though by definition these floating rate saving bonds do not guarantee that they would beat inflation, but if you go by empirical experience, again from April 2016 till Jan 2023, the floating rate saving bonds cumulative returns that they have fetched over these 28 quarters, it has outperformed inflation by about 2.5%.
The last question, of course, is how can one subscribe? But along with that, is there any word of advice or some of the prerequisites that you need to keep in mind vis-a-vis your own financial appetite and a situation that you need to keep in mind before putting your money there?
A very good question and practical question. So RBI has authorized certain agencies in order to issue these bonds. So these agencies are typically your nationalized banks, State Bank of India, and certain earmarked banks like HDFC Bank, ICICI Bank, Axis Bank, as well as the corporation, Stockholding Corporation of India. So, most of these agencies that have been authorized are allowing a potential investor to open their accounts for floating rate saving bonds, both by visiting the physical offices as well as online, as does Stockholding. So in that sense, it's convenient if people, want to do it digitally. And the other part of the question as to what kind of precautions or, what salient aspects one should pay consideration to before they make up their mind, whether they want to invest in these or not, would be one, if at all they consider parking their money in floating rate saving bonds, they should be clear that they are not going to withdraw it for 7 years.
The money at least for 7 years.
Yeah. So from their investable pie of money, they should make sure only that much amount is earmarked for these bonds, which they're not going to touch.
Long-term asset allocation, it goes there.
And secondly, as you rightly said, as part of long-term 7-year asset allocation, because floating rate saving bonds are coming under the heading of interest rate fetching investments, or you can call it debt investment, even though they are not akin to debt mutual funds because they are not subject to any market risk. There's no NAV fluctuation. Yet in asset allocation, when somebody is deciding their asset allocation policy as to how much they're going to invest in equity, in debt, mark-to-market products like debt mutual fund, and in fixed return debt products like bank FD or floating rate saving bonds, which in a way can be interpreted as fixed rate, even though the interest rate gets referenced twice in a year. So they should consider the allocation to these bonds as part of this holistic asset allocation policy. Lastly, I would say that even though compared to those who are in the lower tax bracket or are not paying income tax, it's an excellent investment choice. Because as I said, over and above the prevalent NSE contemporary rate, 35 basis points spread is enjoyed by the investor, which actually is very fruitful. But even for those who are in the higher tax brackets, some amount of allocation within the umbrella asset class of fixed return investment schemes could be considered in floating rate saving bonds, for the simple reason that even if, say, you are in the higher tax bracket, it would take you to have the right estimate of where we are in the interest rate cycle in order to rule out putting money in a floating rate saving bond and choose something which is giving you a fixed rate today for 7 years, say a bank FD or a 7-year Government of India secured.
Well, thank you so much, Yogesh, for all those wonderful insights on floating rate saving bonds. And this was really insightful, and I'm sure our audience will also find this extremely useful. Thanks for watching.